Good afternoon, everyone. Today I'm chatting with David Garofalo from Gold Royalty. In this interview, we discuss what's been happening in the gold market. We discuss China's role within the appreciation of the price of gold. We get into how Iran, Israel, and China may be working in concert to dethrone the US dollar. And David gives us an update on Gold Royalty and how they have a shot at being the world's next big royalty player. All right, everybody, enjoy the interview. David, thanks so much for joining us today.
Glad to be on, Steve. Thanks very much for having me.
So a lot's happened in the commodities market since we last spoke. Gold is, I know that today, if we're looking at our screens, it's not necessarily feeling that good, but over the last, let's say, couple of months or 2024 to this point, it has been encouraging to see gold sort of getting out of that channel that it was sort of stuck in. We've hit as high as over $2,400. What's your read or assessment of the gold market right now?
Yeah, one word, China. Massive amounts of buying out of China, both at the retail level, at central bank level. And it's not a phenomenon that's unique to China, but China's definitely leading the way. Central banks globally are diversifying into gold very, very quickly. There's an undermining of fiat currencies. Interest rates are likely to decline, not only on a nominal basis, but as inflation becomes more firmly entrenched, I think we're going to see real interest rates go deeper and deeper into negative territory. So the opportunity cost of owning gold simply isn't there. And it's really seen as a monetary instrument that can't be manipulated like fiat currencies are currently being manipulated. There's a competitive debasement of fiat currencies that are going on right now to preserve export markets and reflecting the lower interest rates we're likely to experience going forward and inflation. I think that's really what's driving capital into gold. So it's buying from central banks, but also buying at the retail level in China and developing world generally.
How closely are you following what's happening in Japan?
Well, look, I think Japan has gone through a prolonged deflationary cycle for a long period of time. And, they're seeing their monetary instruments being debased as well. And I think you're going to see significant demand out of Asia generally for gold.
So here's sort of a high level. I'm going to put on my tinfoil hat and maybe look at what's happening around the world. And it's been a while since we spoke. So I want to ask you about this. If we think about what happened with Russia and Ukraine, I mean, I know that there was talk of the US sort of instigating that because Ukraine was talking about joining NATO. I'll throw this idea out that perhaps Ukraine was talking about joining NATO because they were afraid that Russia was going to invade them. And so Russia goes in. As far as I'm concerned, they were the agitator there. And then we look at what's happened with Iran and Israel recently. Hamas went into a musical festival in Israel. They were the agitator there. And now I assume that we're watching China and Taiwan. And if China does enter Taiwan, do you think that it tells us that the writing is on the wall here, that the three countries have been working in concert to try to dethrone the US dollar?
Well, I think there's a de-dollarization that's inevitable, simply because there's been such an expansion of money supply for so long that it's inevitable that people will be looking at hard assets, and hard asset prices have to go up. That's just simple economics. It has nothing to do with political conspiracies or war. It's just the value of paper currencies is going down, and it's not a recent phenomenon. If we look over 50 years from when the U.S. government abandoned the gold standard in the early 1970s to today, the gold price has gone from $35 an ounce to $2,400 an ounce, and the purchasing power of the U.S. dollar has declined 96%. That's not a conspiracy. That's simply economics. You flood the market with paper, the value of that paper goes down, and the value of hard assets that you purchase with that paper is going to inevitably go up, and in particular the gold price, because gold has been a currency for 4,000 years. And so when you compare the U.S. dollar to gold as a currency, the U.S. dollar pales in comparison.
So I think that this is a really interesting stat that I came across about a week ago, where World Happiness Index, okay, and if you look at Canada on it, those who are above 60 say that Canada ranks 8th in the world for happiness. But if you look for Canadians under 30, Canada ranks 58th in the world for happiness. If you want to do the US, for people over 60, the US is ranked the 10th happiest place, but for people under 30, it's ranked 62. How much of this do you think just boils down to bad monetary policy and perhaps the end game of the I guess we could say the Keynesian economic structure that we're under.
Yeah, look, I did think it does come back to monetary policy. And the fact is, inflation hits the youngest hardest because they spend a much larger proportion of the disposable income on the necessities of life. Food in their stomach, fuel in their car, roof over their head. And that's where we're seeing the most acute inflation is in those particular baskets, which, the central banks and in particular statistic agencies within our countries exclude from the basket and CPI, which is ridiculous. When the majority of your disposable income goes to food, fuel, and shelter, and you're ignoring it and saying, we've got inflation under control, that's horribly disingenuous. And that's why you're seeing such dissatisfaction among the youngest within our populace.
So I'm sure you're talking to lots of institutional investors as part of your day job working with publicly traded companies, and particularly with a focus on gold in the mining world. I have to ask you, have the conversations changed much in 2024 since gold started running, or is it still largely being ignored by the institutional investor world?
I think it's more the latter. I don't think we've seen any conviction among the generalists yet, but they are dipping their toes in the water. They're doing their homework. They're starting to get up on the equities to see whether there's value there, and looking at rotation out of sections of the equity markets, in particular technology, where valuations are distorted beyond recognition, where multiples are at historic highs. And so they're looking for value, and there is value in the gold sector now. And I would say in particular among the smaller cap players in the gold space, where there's been a dearth of capital extended to those parts of the market for a long period of time. And I think you're going to see a rotation of capital inevitably into the equities. Also, as we're starting to see better and better earnings prints from the existing producers, and we're seeing evidence of that in the first quarter results that have already started to come out, you're going to start to see the value players start to come back into the space. And I'm talking about the generalist value players in the equity space that have largely ignored natural resources over the last decade or so.
So let's talk about gold royalty. High level, if you could give our audience sort of a sense of how many royalties you own that are currently producing, how many are sort of at that development stage where we could see them producing over, say, the next couple of years, and what projects you think is really going to drive the value of the company moving forward.
Well, if you look over a 3-year history, and we're still a relatively young company having IPO'd back in March of 2021, we've gone through exponential growth. We've gone from 18 royalties in our IPO to over 240 royalties today. And to answer your question, 6 of them are cash flowing currently. We have another 14 in various stages of construction, which by consensus estimate gives us revenue growth of 60% on a compounded annual basis right through the end of the decade. This year alone, we're looking at 100% growth in our revenue. And we saw 112% in the first quarter of this year. We already pre-reported our Q1 results on the revenue side. And so we're tipping into free cash flow positive territory for the first time in our history, which again is remarkable for a company that started off as a concept on a piece of paper, back of a napkin, if you will, 3 years ago, to free cash flow positive and earnings positive this year. And that's even at consensus gold prices of below $1,900 an ounce. But we're obviously very leveraged to the gold price at $2,300, $2,400 an ounce. And that's the beauty of the royalty model, is we have unmitigated leverage to the gold price because we have complete protection from inflation that's still rearing its ugly head at mine sites in terms of input cost inflation, capital cost inflation. That's the beauty of the royalty model.
So when I think a lot of people, they hear gold royalty companies, the first name that comes to mind is going to be Franco-Nevada, who with Pierre Lassonde, they've hit it out of the park. What have you learned from watching their model that you think that you have a shot of replicating?
Well, they've perfected it. I'd be the first to admit that. And Pierre and David Harquail, the co-founders of Franco-Nevada, have done an exceptional job of building out a portfolio that's best in class. That's why they have a $30 billion market cap. The challenge they face, of course, is how do you grow off a market cap of that size, notwithstanding the tremendous quality of their portfolio? What we offer is 3 cornerstone assets in the Americas that underpin our business for decades. We have a royalty on Canadian Malartic, a royalty on Côté, 2 of the 3 biggest producing gold mines in Canada. And we have a royalty on the underground extension of Goldstrike, which is the biggest producing gold mine in the US. So we have that quality proposition, much like Franco-Nevada did with Goldstrike when it started back in the late 1980s, early 1990s. We have 3 cornerstone assets within the portfolio. So we're able to replicate quality, but given our relatively small size at only $300 million market cap, we have significant growth, and we can deliver that growth because we're starting off a much lower base. That's the challenge that the seniors in the sector face that we offer. We offer quality and we offer growth.
Now, copper is obviously a big part of the conversation these days when we if you just go on FinTwit, for example, you can't get away from people posting the daily increases in the price of copper. Do you guys have much exposure to copper?
We do. In fact, we bought a royalty on the Cozamin mine, Capstone's copper silver mine in Mexico last year, and that's been a significant contributor of revenue for us immediately. And with at least 6 to 7 years of reserves and another 7 to 8 years of resource beyond that, that's an asset that's likely to be in production for many years to come and offers us significant leverage of the copper price. Within our development stage assets, one of the largest copper gold porphyries undeveloped in the Americas is in Alaska, the Whistler project owned by U.S. Gold Mining, that we have a royalty on, over 10 million ounces of gold equivalent with a significant copper component in it. So we do have a lot of copper gold exposure within porphyries within our vast and diversified portfolio in the Americas.
Now, we constantly hear about mines around the world that are having a hard time getting to production, and also that there's a shortfall of various commodities. We hear about stories like First Quantum and what happened to them in Panama. How do you assess these risks when you guys look to go and take on a project where it seems like communities are fighting mines being developed and countries are just not moving projects forward?
No, it's an excellent question. It's one of the first things we look at. We start with the geological model. Obviously, we have to have some conviction around the quality of the deposit and the potential for it to grow through exploration efforts of the operating partner. But, at the end of the day, a royalty company is just a collection of paper. We have contracts. And if we can't operate in a jurisdiction that respects the sanctity of those contracts, it has jurisprudence that protects those contracts, then really we shouldn't be there. And that's why when you look at our portfolio with over 80% of our royalties by number and by value being in Nevada, Quebec, and Ontario, we offer a distinct quality proposition in addition to the quantity and optionality that we have in our portfolio with our vast numbers of royalties.
Well, David, thanks so much for hopping on here. It's always a pleasure when you hop on here. You're very well spoken and straight to the point, and I appreciate that. I think Gold Royalty is a really interesting company to be watching here as we enter what feels like a pretty big gold bull cycle. So thanks for your time, and please keep coming back on here in the future.
Thanks, Steve. Appreciate your time.
All right, everybody. Thank you for watching. If you enjoyed this interview, please smash that like button, subscribe, and ring that notification bell. Also, let me know what you think in the comment section. Thanks, everyone.